Mondays for this semester. We had intended that all 3 of the sessions this semester be on the Dobbs decision, but the speaker we have lined up for the final important tie-up of that discussion could not attend in December. So that'll be next semester. But we are so lucky because we have Professor Chung, who is an absolute expert on one of the issues that's dominated at least the financial news and the popular news as well, and that is the fall of XTS. It says signed out.
Ben, can you still hear us? Do you see? Okay, so Ben says it's okay, so let's not worry.
All right, we won't worry about it.
It's probably Teams that's doing that.
Yeah, something's screwing up the screens here. At any rate, we're so fortunate to have someone who can really educate us on all the legal issues surrounding this, even if you're like me and don't entirely understand blockchain and cryptocurrencies and all that sort of thing. And I think one of the most fascinating things about subjects we study in First Mondays is that we come to law school thinking that law is fixed, and somehow after 500 years of Anglo-American history of law, then most questions must be answered. But in fact, we find once we start law school that that's not true at all. And we get to watch instances, as with this one, where we watch the law respond to something that was way ahead of the law. We've seen that with so much technology, but certainly with this issue. So it couldn't be more timely to have Professor Chung here to speak about it. And I turn it over to you. And thank you so much.
No worries. Let me just get the mic on. One of the things about all of our tech now is it's just this buzz that you hear when you're at the podium. So if you can't hear me or if I'm being too loud, I need you to tell me because all I hear is this wall of like white noise. But thank you for coming to this final, I guess, of the semester, First Monday. When this all started to implode or come into the news, really within the past 10 days, it seemed like I mentioned to Professor Reyhan, hey, should we talk about this? Because this seems like it's a big deal. So I'm glad we were able to fit something in. And I look forward to the next semester's conversation, a continuing conversation about Dobbs. But I'd like to talk with you a little bit about FTX. And I'll just warn you now that there is some salty language that some of the participants have used that's been quoted in the press. And so, I'll try to kind of censor, but just warning you now. So I want to start by just sort of giving you an overview of where we are. And then how did we get here and what are the implications and what should we be thinking about in terms of regulatory themes? Like as lawyers, we like to think about what are lessons that we may be learning or have learned, or what are some themes that we ought to be thinking about with respect to the regulatory system. So I'll try to finish with that. So what the heck is going on, right? Okay. Oops. So earlier this month, as many of you know, because you're here, FTX, part of the FTX group filed for bankruptcy protection in United States Court, a Chapter 11 proceeding, which is a debtor in possession proceeding, as we'll discuss later, right? This marked the collapse of what had been a crypto empire, really a sprawling empire that crossed borders and business lines, headed by 30-year-old entrepreneur Sam Bankman-Fried, or SBF as he is known to his friends. The bankruptcy filing, the Chapter 11 filing, included the main FTX crypto exchange, and I'll talk about what that is. The US crypto marketplace, because the US piece of this business is actually far smaller than the international piece for regulatory reasons. SBF's proprietary trading group, Alameda Research, and about 100 affiliated companies or other entities. So LLCs or other business entities, right? So it's this big sprawling bankruptcy. And that's not even all of FTX. It's just parts that you kind of get into the Chapter 11. The filing came after SBF failed to find a cash infusion following a torrent of customer withdrawals that had been prompted by concerns about FTX's financial condition and by FTX's links to Alameda, again, his proprietary hedge fund. The collapse of FTX's exchange was just huge earthquakes, basically, because FTX, as you'll see, had promoted itself as kind of the non-sketchy way to get involved in crypto. They had had a commercial that ran during the Super Bowl last year, basically saying, trust us, this is the safe way to dip your toes into these waters. And in the wake of the collapse of FTX, other major coin entities plummeted. There have been or will be more bankruptcy filings likely shortly. And the price of, just things, the market definitely wobbled. SBF himself resigned from the company on 11/11, and FTX is now in the hands of a corporate turnaround specialist. And we'll see what he's had to say about what he found when he began looking into under the hood of FTX in just a couple of minutes. And their probes likely DOJ and SEC as well. So, within a span of really just a few days, people, FTX went from being like, oh, everything's okay, to bankruptcy. Okay. So I wanted to talk about who are the players first. Okay. So who are the players? SBF obviously is one of the main players. He's 30 years old, Silicon Valley born. Both of his parents are professors at Stanford Law School, educated at MIT. He had launched his hedge fund in 2017 called Alameda Research after stints in the charity world and working at a trading firm called Jane Street. And by 2019, he had already had Alameda up for 2 years. And in 2019, he launched FTX as a crypto exchange platform that offered perks to people who wanted to trade crypto, such as low trading fees and advanced option techniques for users. He was rich before all of this started. And we don't know how rich he is today, probably a little bit less. But, both Alameda and FTX did very well. And his fortune was substantial. He was listed on the 2022 billionaires list as having a multi-billion-dollar fortune. Okay. So that's SBF, right? Sort of a wonderkind who didn't have too much experience running large sprawling enterprises before he started what has now became FTX. Alameda, as I mentioned, was his first foray into this space. It was a proprietary trading platform and hedge fund that he established. And this little quote here before the petition date, the Alameda silo operated quantitative hedging trading funds specializing in crypto assets. That's from the bankruptcy petition. So this is how the current CEO is describing what Alameda is. Shortly after its founding, it was a multi-million-dollar business built around trading and borrowing crypto tokens. So Alameda exists because of crypto. That was its principal business. And that's where he first made his fortune. And that's what caused him to open FTX, the exchange. FTX is an exchange. So what is crypto and what is a crypto exchange? Those are both easy and hard questions in some respects, right? Because I can tell you, and then you're like, okay, I see that those words are up there, but what do they mean, right? So, basically a crypto exchange enables customers to trade digital currencies for other digital currencies or for traditional money. So if you have Bitcoin and you want to exchange it for dollars, in theory, you could do that via a crypto exchange. If you had a different type of digital coin or token and you wanted to exchange that for Bitcoin, you can do it via a digital exchange. It was pitched as an easy way for people to buy, sell, and store crypto. So as FTX grew, it had this both exchange function as well as functioning kind of like a bank where people would deposit their assets, their digital assets, in a wallet that kind of was on the FTX platform. So customers were using it in those two different ways. And that will become important, as we'll see when we get to what has gone wrong. As I mentioned, FTX marketed itself as a non-sketchy way to do crypto in this way. Number one, they said, we get that the idea of a digital token can be confusing to people, and that digital tokens, like any kind of investment, could be risky. So rather than own the tokens themselves, invest in us, the exchange, right? So it was kind of one step removed from the volatility of tokens. And so they pitched themselves as kind of a safer way to buy, sell, and hold tokens, but also for investors in FTX as a way of dipping your toes into the market of crypto without subjecting yourself to the risk of any kind of random digital asset that you might have. So kind of marketing to both investors as well as to users of the FTX exchange. And FTX marketed itself as a safer alternative, and people saw it that way compared to the other major player, a company called Binance. FTX was perceived as seeking smart regulation, whereas Binance was perceived as avoiding all regulation. Binance was founded in China in 2017 and now operates out of the Canary Islands, but has no official headquarters. It is known for pushing the envelope. Financial regulators around the world have issued warnings to Binance for operating without a license or violating money laundering laws or for working with countries that are subjected to sanctions. They've been ordered to get out of the UK. So if you're wanting to do crypto and you want an exchange because you want the ability to kind of go back and forth between money and crypto or different types of crypto, and you're looking at FTX versus Binance, FTX seemed much more reputable. And it definitely played that up as a marketing pitch, right? All of this meant that FTX was a venture capital darling. In just over 3 years, FTX secured about $22 billion in investments and a multi-billion-dollar valuation, and sort of had the royalty of Silicon Valley as their VC backers, particularly Sequoia, SoftBank and Paradigm are three well-known firms that invested in FTX. So meaning they gave FTX, they were an investor in the business, not in they weren't trading crypto on the exchange. I mean, but they gave SBF money as investors to establish this sprawling empire. So it's a lot of money very quickly. Okay, so what is crypto, right? We know what an exchange is now. It's a place to exchange crypto, but what is crypto? So they're a type of digital token that can be held and exchanged on blockchains, which are basically publicly available ledgers that record ownership without having any central authority and control. So there's no central bank. So if you have a Bitcoin, right, that means that it's a digital token. It's a digital thing. There's not a physical piece of paper. It's not issued by a bank or a currency like authority. It's not the US dollar, right? It's a digital token that has a value as determined by what people will pay for it, right? What would a willing buyer pay to a willing seller in an arm's length transaction? And it's kind of recorded in this ledger that is this blockchain technology. And the thing is, it's kind of by design, both anonymous and decentralized, because you don't know who owns a wallet. You can see that there's a wallet, you can see that there's a Bitcoin someplace, but you don't know who owns that wallet necessarily. And again, there's no central bank behind any digital asset, any digital token. So there's not a US government printing press when it comes to Bitcoin or any other country, right? It's decentralized, there is no backing, which is like, you say that and people are like, yeah, there's no backing. And then when something goes wrong, they're like, where's the backing? And you're like, we said there was no backing, right? That was the allure of this all, right? The anonymity and the decentralized nature of it, right? So FTX was important and big because together with Binance, it did the majority of these transactions on an exchange, right? So they're a significant player in this space. And like I say, they're both of these businesses cross borders. And that's largely because a lot of what they do is not permitted in the United States. So the US operations for both entities are quite small because they have to comply with US regulation, which is considerably more strict than other countries. So think of it as going to like an offshore casino, right? Because that's kind of what it is. And things can happen internationally that can't happen in the United States. But it makes it complicated now because this empire spans many countries and money is fundamentally fungible, and digital tokens are even more kind of cross-border in nature and not subject to state regulation in even ways across the world. So this is a big, sprawling, money-making enterprise. There's real money at risk here, not just sort of a Bitcoin, which in theory has value because someone will pay you for it. Okay. So why did FTX run into trouble in within the past 10 days? Okay, because until recently they seemed to be in fine shape. But what happened is that on November 2nd, a trade publication called CoinDesk published an article that raised significant concerns about the finances of FTX. So first, they said two things. First, they said that a lot of basically they said, Alameda is intimately connected to FTX. So SBF, so his hedge fund is intimately connected to FTX in ways that people didn't initially understand. When they started to understand it, they realized that a lot of the assets kind of, on the books of these entities were in the form of digital tokens that they had invented. So these FTT tokens. So basically imagine that FTT is like, you and I just decided to walk up to the photocopier and we printed something that said FTT on it. And we said, here it's worth $22. And if you ask me why, it's because I said so. Okay. So they had created these various types of digital tokens, and they said that they were worth something. When you looked at this balance sheet that was leaked in this CoinDesk publication, a lot of the supposed value of Alameda and FTX was wrapped up in these proprietary digital tokens. So everyone was like, whoa, number one, we didn't realize these two businesses were so related. And number two, there's an awful lot here that is just worth that because they say it's worth that, and we're not sure it's worth that, right? So, you know, so it looked like the market began to be concerned about whether issues at Alameda threatened to bring FTX down. And they basically were worried that both companies were hiding losses on these digital assets that they had incurred in the spring when there had been a huge kind of instability in the crypto market, right? So there was a concern that this stuff was really just made up. It wasn't really worth anything. And they were in fact hiding losses in crypto markets. So the CEO, when this article came out, and again, it was a leaked balance sheet that just a furor erupted after the article was published. Initially, the CEO of Alameda, who was not SBF, but someone who he had installed in that role, tried to assure markets that everything was okay. And for a little bit, people were like, okay, but that didn't last very long, because what happened is that Binance, which had owned some of these FTT tokens, said, we think this is not, we're concerned, we're going to sell everything. And they were the biggest holder. So if they were going to sell, it just tanked the market. So once Binance said we're out, that was a huge problem for both Alameda and then for FTX. You know, not only were prices dropping in crypto markets, but there were a torrent of customer outflows, because like I said, customers had been using it like the bank to just hold their digital assets. Customers began pulling the money out once this article came out, and once Binance, head of Binance, said that he was selling all of his tokens. So this was a problem, right? So what SBF initially, he wanted a lifeline, right? This is a sprawling enterprise, and he's at the head of it. So first he asked Binance, would you basically just acquire us, right? And there's sort of a long and very colorful history between these two companies that I won't go into, but the first thing was go to your competitor and see if they'll acquire you, which was like a hard pill for him to swallow, but you know, he really didn't have a choice. And initially there's this, okay, there's going to be a strategic transaction, and there was a non-binding letter of intent. But non-binding became important because within 48 hours of due diligence, after doing about 2 days of due diligence, that CZ, who's the nickname for the head of Binance, walked away and said, we're not doing the deal, right? And SBF tried to get money from prior investors, but they said, no more right now. And thus there was a liquidity crunch, and that's what ultimately caused the company to have to file for bankruptcy. In the midst of this, SBF resigned. That wasn't, he resigned, but I don't think he had much of a choice, right? And he started tweeting out, I'm sorry, I effed up, you know? And so, you know, within really the span of less than a week, things went from okay to bankruptcy, resignation, and the kind of, you know, admission that something had gone wrong, okay? So, you know, what do we know? What have we found? What do we think happened? Okay, like I say, sketchy balance sheet was a big part of it. When this balance sheet was leaked, when the Alameda balance sheet was leaked, that was a big problem. But now, following the bankruptcy, we've seen FTX's balance sheet for what it's worth, because as we'll learn in a minute, this company has no reliable financial records. These collective entities have zero reliable records, right? They don't know what they have. It's a mess, right? But what was started to come out as all this was, you know, with the filing, is that FTX's balance sheet had comparatively few easily saleable assets. It had substantial liabilities, and a lot of the assets were in the form of like digital tokens or other illiquid things, you know, that couldn't be sold to raise cash in response to this cash crunch. So they're illiquid venture capital investments, crypto tokens that are not widely traded, balance sheets that contain ledger entries like hidden, poorly internally labeled account. That's like an actual entry in their financial statements. Other holdings, including this new token called Serum, that basically is just another fictitious thing. And financial statements, which not only do not accurately describe assets, but excluded liabilities. You can't just do that. You can't just record your assets and say, I'm just going to like close my eyes and engage in magical thinking about liabilities, right? So sketchy financial statements, including balance sheets, which reveal a lot of this company is kind of built on what we would call vaporware, if you will, like tokens that only mean something because somebody once said that they meant something, but probably don't mean anything. We're also seeing that the lack of financial controls went beyond just not showing assets and liabilities, but also in potentially the use of customer funds. And basically they took customer funds that were stored in the bank kind of piece of FTX. And apparently SBF caused those customer funds to be sent to Alameda, which he owns as his proprietary hedge fund. You can't take customers' money to pay off basically debts of your own enterprise. So there's sketchy financial statements. There's apparently the misuse of customer funds. And all of this is kind of wrapped up in, again, a complete absence of internal controls and financial record keeping. This is a quote from a filing that was, this is the new CEO of the company. And this was a filing from late last week in the bankruptcy proceeding. And you can see, this guy is no joke. He have over 40 years of legal and restructuring experience. I have been the chief restructuring officer or chief executive officer in several of the largest corporate failures in history. I have supervised situations involving allegations of criminal activity and malfeasance, the Enron case. I have supervised situations involving novel financial structures, Enron residential capital, and so on, right? He's been in most of the major restructurings that have happened in recent years. Notwithstanding his prior experience, he says in paragraph 5, never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. From compromised systems integrity and faulty regulatory oversight abroad to the concentration of controls in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals, this situation is unprecedented. Right? That's a lot to say when you're talking to the guy who's been around for 40 years and who acted as a CEO or CRO in cases like Enron, right? And when you read about what went on, and you go in and you read this pleading, I'm just going to give you a few excerpts. I would say from my perspective as a cynical person, having been in this space for a while, it is both shocking and unsurprising, which may seem like those two things couldn't go together, but I think it's shocking. The degree of it is just astounding. Like, how did you get to be this big and basically do things on Slack, which is, Slack, as we'll see. But it's not surprising because this is what can happen when you give $2 billion to somebody with no experience and say, we trust you because you're smart, right? No oversight, as we'll see, which as the lawyer in me is offended by that. But let's just get a flavor, right? Many of the companies in the FTX group, again, this was a sprawling empire, had never had a board meeting ever. Corporate funds were used to purchase homes and to pay for personal items for employees and advisors. These transactions were not loans, or at least they have not been documented as such, because the real estate, there's no evidence that here we'll loan you money so that you can buy a house, which is, potentially entirely legitimate, versus taking corporate assets and handing them to individuals to buy houses that they then will own in their own names. You can't just take money from the company and use it for personal purposes. There's like kind of fundamental corporate governance principle, okay? FTX employees submitted payment requests through an online chat program, I think it was Slack, where basically people would just either approve it or not approve it via emoji, okay? The accounting firm for one of the business lines was a firm called Prager Metis, which bills itself as the first ever CPA firm to officially open its metaverse headquarters in the metaverse platform Decentraland. Okay, I may be old and crabby. Well, what is that? Right, it was just endemic, right? It was like, of a lack of control, right? And then this is a longer excerpt, they were using, it wasn't just poor controls over the money, it was poor controls over the business and the assets of the business and the confidentiality of certain data. They would use group email accounts to store and access and transmit private keys and critically sensitive financial information. They use software to conceal the misuse of customer funds. They use software to conceal Alameda's exemption from certain aspects of financial, of the way the finances were supposed to work at the company. And all of this was happening, under the direction of and under the control of SBF, who was basically in control of everything. Right. So you had a very small team, all of which were loyal to him, many of whom were not terribly experienced in this sort of work, overseeing the financial operations of the company and basically doing nothing to ensure compliance with any kind of rules or basic principles of corporate governance. And then there's some suggestion that some funds may have gotten into digital wallets personally owned by founders, and we don't know the state of that yet. Okay. And I will also say, adding on to this problem, the new CEO has uncovered that roughly $500 million in tokens appear to have disappeared, whether it's the result of a hack or a theft. So in addition to not knowing where the money is even amongst the players, we don't know where the money is amongst the non-players either. Okay. So initial reports, like I said, spoke of misuse of customer funds, unlawful transfers. SBF has pushed back on that characterization of what's gone on, basically saying that he misread labeling, internal labeling was confusing, and he may have misread like ledger entries and that sort of thing, which is okay, but you're the one who was in charge of all that. So if you misread it, isn't that on you, So he's pushed back a little bit. He has pushed back on the idea that this was sort of the theft of and misuse of customer funds, by saying it was kind of a misunderstanding and the product of mistake rather than intent to deceive or defraud or theft. Okay, so that's kind of at core what happened. This is a run on the bank case, right? The market was initially quite concerned about, was okay with what was going on, but became concerned. And that's what precipitated the bankruptcy filing and his resignation. It's not clear that that would have happened, but for the fact that the market learned how much of this business was basically dependent upon the value of digital tokens, including tokens that they had created themselves and assigned value to. And I don't think we would have known about the complete lack of internal controls absent this run on the bank and the installation of a turnaround and restructuring CEO. So what are some themes I'll just briefly mention before, if anybody has any questions or just comments? Let's talk about, some themes that we're seeing, right? I think one big theme is tons of money and no oversight. And this is tied up in the myth of the rock star CEO, right? Investors gave SBF so much money, and there's no question but that FTX was a very hot startup and people were clamoring to give him money, right? So the reporting indicates that, it was sort of a take it or leave it proposition. He didn't make so much as a pitch as he said, these are the terms, if you want in, these are the terms. And not only did he sort of say, these are the terms, there'll not be negotiation over the financial terms of this investment, but he also made it clear to investors that he was going to run FTX with little oversight, and that an interested investor should be prepared to support and observe him, but not to kind of exercise control over him. Investors who questioned his decisions were tended to be excluded from future rounds. That's what he would say, fine, but if you question me, you won't be invited in future rounds of fundraising, so your position would be diluted, right? And investors responded to all of this by giving him $2 billion, as I mentioned, over just a couple of years, right? Hold on here. Oops, sorry. Part of the reason he got away with this is because he was perceived to be a wonderkind, right? He was young, he was, thought to be a genius, and we'll discuss how that happened in a minute. There were these fawning articles that I have some excerpts from where people talked about his genius. There's a discussion in this article, among other places, about how during this critical VC pitch to Sequoia, the firm that gave him tons of money, where he played League of Legends the whole time, which is an online multiplayer game. He was a major donor to political causes, particularly the Democratic Party, and he had close ties to Wall Street, as well as Silicon Valley. You know, he had just grown up in that milieu. You know, he grew up as I mentioned, the son of two Stanford law professors. He went to MIT. You know, he'd worked at a trading shop. So he had all of these connections, and he was viewed as genius. And because he was viewed as genius, people understood and thought they didn't have to watch him very closely. Right? This is a quote from this article that was on the Sequoia Capital webpage until very recently. They have taken it down, but like the Wayback Machine exists, so we can see this article, right? You know, Alameda was just one guy in a Berkeley apartment making a single cryptocurrency trade. The guy was SBF. The trade he made, you know, was this. He basically was able to capture this difference between the price that Bitcoin traded in Asia and the price that Bitcoin traded in the United States. It was higher in Asia and lower in the United States. And he was the first person to be able to capture that difference and arbitrage the price difference, this kimchi premium, and it was called. And, you know, when he pulled it off, it made him a billionaire, and he achieved the status of legend. You know, he was like 20, in his late 20s when he did this. And the next thing is about the League of Legends. And I'm going to apologize for the salty language now. Sorry. I hope no one's offended. Right? So this is someone who's on his team. So this is not, right? I sit 10 feet from him and I walk over thinking, oh, that was really good, remembers Aurora. And it turns out that the jerk was playing League of Legends through the entire meeting. Okay, now look at this next sentence. We were incredibly impressed. This is the VC person. He's impressed that this guy asking for millions of dollars was playing League of Legends during the pitch meeting. It was a sign of his genius that he was able to multitask in this way, right? I want to ask you, do you think anyone would give you money or hire you as an attorney if you played League of Legends during the critical pitch meeting where they were presenting to you? I don't think so. I don't think most of us get away with that. But what kind of you would be considered unprofessional behavior was seen as a sign of his genius, right? So, but not only was it like League of Legends that it was impressive, but it was impressive that he was basically like engaged in this mass kill thing on League of Legends while in the pitch meeting, right? So I'll let you guys read that, right? So he does this and he raises millions of dollars, okay? And so, you know, I think part of this is the myth, like the infallibility of genius presumption that happens when you've got smart people who do things and then suddenly they can do no wrong. And suddenly things that would normally be disqualifying are seen as, oh, that's why I want to invest, as opposed to that's why I want to run to the hills. Okay. Now, so I think one theme is again, this sort of the myth of the rock star CEO, right? Where there are people who are supposed to be exercising oversight don't. I think another theme is kind of the approach of business to regulation, right? Now, business is almost always going to prefer less regulation rather than more, right? And it's capitalism. It's okay. They don't have to like love lawyers, you know? We don't have to agree with them, but you know, it's okay to, I mean, I think businesses will want less regulation. They will also engage in regulatory arbitrage, meaning they will choose lines of business and they will structure products and services to avoid what they perceive to be heavier regulatory burdens. I'm not saying I think it's awesome. I'm just saying I think that it is not surprising that business would prefer to have less regulation rather than more, right? I think that, you know, but then what happens, two things can happen, and sometimes they happen at the same time. One is that you'll get one player who will say, oh, I'm for regulation, but I'm for smart regulation, which is what FTX did, right? Because they didn't want to be Binance. They wanted to capture something of a virtue premium. So they were out there saying, we just need smart regulation. We think that there should be some to kind of legitimize the crypto industry, but it needs to be smart, right? Because Binance was saying none, and they were like fleeing jurisdictions that tried to impose any regulation on them. So FTX was, you know, we're like the safer, friendlier crypto in part because we're willing to countenance some regulation, just so that again, to signal that we're a safer place for customers and investors. Okay, so that goes on, right? And then there's, you know, regular conversations about what is smart regulation and what might it look like, right? So you get businesses saying that they want regulation, and likewise, you get businesses not wanting regulation at the same time. So what that can result in is a kind of performative call for regulation, which is really just a call for, let us tell you how we think we want to do it, and you just bless it, regulators, right? And I think that's what was going on with FTX. There was a performative aspect of them calling for regulation, because when push comes to shove, you know, what does he really think? Well, what I'm going to show you now is a text exchange with a reporter that happened after the bankruptcy filing where SBF is kind of unrepentant. He says that he says that he thought that they shouldn't have filed for bankruptcy after all. He regrets that. And this is what he says. So the reporter is in blue. The reporter says, and this is him, like, you know, his lawyers are probably having a conniption that he's like messaging with reporters, but the reporter says, you said a lot of stuff about how you wanted to make regulations just good ones. Was that pretty much just PR too? And then there's this conversation, right? Yeah, just PR, F regulators, they make everything worse. They don't protect customers at all. Okay. And then there's another page of this that I didn't include where he basically says, you know, his view is essentially, there's no way they're smart enough to do this. Right. And the reporter's like, yeah, but it's not like you guys did a better job. And he's like, so there's this idea that like, yeah, we just want smart regulation, but it's like, there never will be smart regulation really for someone like this who thinks this, you know what I mean? At the end of the day, he didn't think regulators were capable of coming up with a regime to handle crypto. So, you know, my reason in a way for wanting to talk about this in a First Monday is to say to you that, you know, there's always going to be a couple things. There's always going to be rogues out there. So you're going to see financial frauds and white collar crime involving rogue employees. It's very hard in large, complicated organizations or even small ones to prevent someone who's intent on doing harm for doing harm. Because when you're just one person and you're trying to like steal money, you cover your tracks, right? It can be hard to catch the one bad apple. Okay, that's not this case. This isn't the case of one person run amok, right? This is a case that speaks to, you know, regulatory oversight. It speaks to money, giving money to smart people, but imposing no conditions upon that money and exercising no oversight. This is not a case about the failure of one person to play by the rules. It's the failure of a multi-billion-dollar enterprise. That's what's going on. So I want you to think about that when you hear that, like, oh, you know, he's not representative, or that's not representative, or this was just a few mistakes by one person. That's not this case, right? Number two, I also want you to recognize that there are hard conversations to be had about regulation. You know, regulation isn't inherently good or bad, right? It depends on what it is. And it can be hard to have regulation that appropriately balances risks and benefits in ways that are financially realistic, right? I mean, the only way to have no risk is to have in crypto is to have no crypto. And if we make that decision, that's fine. Like, I'm not saying I don't think we have to have crypto. Personally, I'm not convinced. But the point of it being is that there's always going to be hard conversations that you have to have as lawyers and public officials about what is the right mix of regulation and freedom from regulation, right? And the fact that a conversation is difficult and challenging, or a technology like crypto is challenging, isn't a reason not to have the conversation. You know, I mean, this attitude where, well, we want regulation, but they're incapable and nobody's capable, so you should just let us do what we want. You know, I don't buy it. I think it's possible as lawyers. It's never going to be perfect. You always will need to make adjustments, amendments. You know, you need to continue to have conversations. It's not like you regulate once and that's the end of the entire story. But don't fall into this trap of thinking that because it's a hard conversation, it's one that you shouldn't have at all, or that it's futile to have it. Okay. And number three, I think that this is a reminder of the responsibility of fiduciaries in this situation. Because, you know, I don't necessarily feel bad about Sequoia for making taking the risk of investing in FTX. That's the job of a venture capital fund. It's it's investors' money. Investors have hired Sequoia to invest it for them. You know, I don't think we should. I mean, I don't. They had an opportunity to do due diligence. Their eyes were open. They made a bet, and the loss of their entire investment won't hurt them because they're a multi-billion-dollar enterprise. They're very successful, right? So, you know, I'm not saying like I'm glad you lost money, but I just think they're adults. It was their decision to make this investment. I feel a little bit worse for the Ontario Teachers Pension Plan, which was an investor in crypto. And it's a reminder that, you know, when you are in a fiduciary role as the trustees of that plan, take that seriously. I'm not, you know, I would be hard pressed to understand why a pension fund is investing in crypto, right? I know it's super hot, you know, and I know it's like it's got that sexy feel to it. But when you're a trustee, and lawyers often are in the role of trustee or owe that duty of trust and confidence to their clients, take that seriously. Just because something is all in the news doesn't mean it's a great investment, right? So take the role of the fiduciary seriously when considering whether to deploy funds in new and untested technologies, products, and services like the ones that we see here. So I think those are some immediate lessons that we're only now just starting to learn. But the story is only in its earliest days. And so I think we're going to see there's a lot more that we'll have to learn as time goes on. Anyway, that's just a quick overview. So thank you. I wonder if anybody has any questions. Yes.
The venture capitalist fair successful relationship between Alameda and
I think, yeah, I mean, they knew that obviously Alameda, they knew was his shop, right? Because that was his proof of concept. What the unattributed quotes suggest, they didn't realize how financially interdependent they were. They didn't necessarily realize that he was taking FTX's assets and, at some point and sending them over to Alameda. And it has been reported that he concealed those transfers from other FTX executives. So I don't know yet. I mean, I think it's early to know, but my guess is that I think they probably didn't know the degree to which all this was built upon the value of tokens that they had issued, and also that there was potentially this flow of funds from FTX to Alameda. But I would also tell you that they weren't watching either, right? So if they didn't know, I mean, yeah, he might have concealed some of it at the 11th hour, but I think that there was a failure of oversight. Yeah. I think that even if they did due diligence at the time, I think that they didn't watch what was going on, right? They weren't being careful stewards of their investment. That is my guess. I mean, that is a prediction. We'll have to see how the facts play out. But the initial reporting has been that they weren't aware of kind of the degree to which there was this they were interwoven financially by the time things went wrong. Yeah.
and apparently a romantic SBF. So
Yeah. I mean, that seems like the least of the problem.
I know exactly.
Yeah.
That might explain why he was.
Yeah. I mean, I think, basically he just ran, he had control. He was, you never, with financial reporting and financial operations, you never want there to be like a single point of failure. You always want to have there to be like a second signature on the check, so to speak. And that didn't really happen here, is that, there were just a small coterie of people who he could do what he wanted. And, as the person in control, he was in a position to conceal what he had done. When you read the filing by the new CEO, they basically categorized the businesses into these various silos. And for every one of the silos, he says there are no reliable financial statements, and those that exist are basically were prepared or are under the control of SBF, and they're not reliable. I mean, he's flat out says that they're not reliable and they were under his control. So, I mean, which explains the SBF's defense, right? Which is like, oh, I didn't mean it. I just misread ledger entries. Okay. Yeah. Mm-hmm. Yep.
But my question is more, if it is sort of a bank run, what extent does the balance sheet problems sort of spark a liquidity run? And if that was truly the case, is the solution to like a traditional bank hold more in US dollars on the books? Like would we be here if there was sufficient capital?
No, I mean, if they could have, I don't think we would. I think the issue is that, as I said, customers were using the platform as a bank in addition to like an exchange platform. So when the CoinDesk report came out, people started pulling their money out of the bank, right? And that meant that they were essentially, some of them were just trying to get dollars, right? There wasn't enough money to satisfy their withdrawals. Because remember, much of the assets were in the form of digital tokens, which the value of which was uncertain at best. So that was the problem. They didn't have immediately saleable assets that could be used to fund redemptions. And so if the report had not come out, I don't think we would be here. If the liquidity crisis had not happened, I don't think we would be here. If he'd been able to get a lifeline, either from his existing slate of investors or from Binance, I think we wouldn't have been here, right? Because, these are private companies. The balance sheet that was in the CoinDesk report for Alameda was leaked. So I think, it does, had there been more saleable assets or some way to satisfy the redemptions, but that's what happens, that's why it's not surprising that, I wouldn't have expected them to have dollar for dollar, so to speak, right? But I think the degree to which it was a house of cards built upon the value of tokens that they had issued, I think was surprising to people and accelerated the crisis.
And then you're back to a company that is based on US dollar. Sort of being hypothetical.
Yeah. One thing that's interesting that I haven't mentioned yet is that they, so a lot of the operations were run out of the Bahamas. They had basically a condo, where they all were in the Bahamas, and the Bahamian authorities have initiated a liquidation proceeding. And so there's a turf war now happening, starting to erupt between the US bankruptcy and what's going on in the Bahamas. And so the Bahamian authorities have filed a petition under Chapter 15 of the Bankruptcy Code, which is a kind of coordination chapter that is when you're dealing with a situation where there's people and assets across borders. This is a provision which says, let this foreign proceeding take the lead with respect to certain aspects of this proceeding. So the Bahamas is like, hey, we want to take the lead as to this one FTX Digital, which we think is not part of the Chapter 11, because we've got this liquidation proceeding ongoing. So appoint us in charge of this thing. And then the US folks are like, wait a minute, no. And they attribute lack of oversight from foreign regulators as part of the problem. So we're starting to see this competition between domestic voices and this foreign regulator seeking to do a liquidation. So there we are. The Sequoia website now, where this article once was, the Sequoia website now references a liquidity crisis or liquidity crush as being, and they've taken down their hagiography. Any other questions?
I know we have people who need to get to class. Thank you so much.
Oh yeah, okay, sorry. No, Ben is just saying we should use our mics, but I think I forgot to ask that. So I think we're good. Is everybody finished up? Thank you.